The market is up 26.7% from last October. I quite frankly did not believe in this rally, and I will tell you the reasons why. However, what I decided to do is to make a list of all the indicators that I follow, the ones I look almost every day, and then I analyze and question myself, what do they say? Should I rely on them? Yes or no? Anyway, I made a big list of all these indicators, and I divided in two parts. The bulls and the bears, the ones that are telling me that the market, this is a real bull market, so be careful, you're going to be left behind. Then I made another list of indicators that are telling me, and they've been quite reliable, that this is just a rally in a bear market. I'm going to go through all of them, and I'd love to hear from you what you think. Okay, here we go. Okay, let's start with all the indicators now that I put together, and with that telling me that this is a rally in a bear market. Let's see what they're saying. This chart shows the stock market, the red line. And what the blue line is are spreads between low-grade and high-grade bonds. And when the spreads rises, that means that there is credit risk. Some companies are not doing too well, and they overextended themselves with debt and other things. But when the spreads reaches around this level here, what you usually see is a market peak. In other words, from a fundamental viewpoint, there is too much risk in the economy, and therefore what this measure suggests that the best way for business is to be conservative and raise cash because credit risk is high. The red line shows the growth, the change over 12 months in stock prices, and the blue line shows the change in profits. So this shows something that all investors know. Growth in stock prices reflect the growth in profits. And of course, if the economy slows down, profits go slow down, and therefore the implication is that the red line is going to be depressed. But let's dive more into it. The blue line again is profits, the same line I showed you in the slide before. And the red line is the yield curve. In other words, is the difference between the 10-year yields and the 2-year yields. When the difference is negative, that is the 2-year yields is above the 10-year yield, then usually what you see, not usually, always almost 100% batting average, you see a recession coming, and the end of the recession is way after the yield curve started steepening. This has happened here in previous instances, has happened here. And what the current point is saying is the yield curve is so steep that it didn't even start turning around. So the implication is that profits will continue to decline. Notice that when the yield curve starts steepening, profits improve months and months and months later. So what the yield curve is pointing is that profitability is going to be in bad shape for the next several months, maybe 1 year at least. So this, of course, is bearish for the market based on what I talked about in the previous slide. The red line shows the stock market, and the blue line is the yield on 2-year treasuries. What is important to notice is that a rise in the 2-year treasuries is followed by a beginning of a bear market. A rise in the 2-year yield is followed by a peak in the bear market. A rise in 2-year yields is followed by a peak in the stock market. What is even more important, and people do not look at it in this way, is that the bottom of a bear market follows a decline in short-term interest rates lasting at least 6 to 12 months. And that is an important thing. By the way, there is another statistic that is very useful, and is that I went back to the 70s, and when interest rates peak, they decline at least 4 percentage points, but most only once. The other times is at least 5 percentage points, but that's a different presentation. But anyway, what is important here, that to have a bear market bottom, short-term interest rates have to decline for many, many months, and this is not what is happening now. This chart shows the stock market is the red line, and the blue line is the yield curve. The yield curve here is measured as a difference between the 10 years and the 2-year treasury yields. So when in this area, the yield curve means that 10-year yields are greater than the 2-year yields. But when the yield curve goes negative, that means the 2-year yields are higher than the 10-year yields. And at that time, it says the curve is inverted. Right now, the curve is inverted, as seen very rarely in the history, in the financial history. And this means that there is some serious credit risk out there that we don't know anything about it. But anyway, this again is another presentation. As far as the relationship with the stock market is the follows. If this is the peak of the market, the peak of a market, the beginning of a bear market, what you see is that the peak of the bear market coincide quite closely to an inversion of the yield curve flattening or becoming inverted. And it happened here, and it happened here. So if this is the bottom of the bear market, 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 the bottom of the bear market here, what all these bottoms have in common is that yield curve is steepened. In other words, the 10-year is greater than the 2-year yields. So you see this becomes positive, but the bottom is here. So it takes all these many months. It takes all these many months for the bear market to end. So the implication is that this curve will have to become positive and then go up before this quote-unquote bear market is over. And this is something to think about it, because this indicator is quite reliable. So the issue is this the beginning of a new bull market? Well, one of the things that happens at the beginning of a bull market, which means the economy is going to strengthen and business is going to be much better, is that the small cap stocks are likely to benefit the most. And what you see, the small cap stocks, here is the ETF IWM that is being plotted, tend to rise faster and outperform the market. But here, as you can see, there is little or no action in the small cap stocks. In other words, the small cap stocks, the small cap companies, I should say, they still have many problems. So that means that the economy is not that strong as the bulls would like to believe. So this is a sign of caution. Okay, we have reviewed all the bearish signals, and as you probably noticed, they're mostly fundamental. It's about the relationship between interest rates, profits, the economy, and the stock market. So is the view of the macro strategist, if you wish. Let's look now at the bullish case. The bullish case, the way I see it, is more practical. It's more down to earth. It's less exotic. But maybe, who knows, maybe it's more useful. Let's see. This is the VIX inverted, the volatility index. So when this curve rises, means the yield curve, the VIX is declining, and this line is rising, and the stock market rises. Not only that, but the VIX now is above this line, which says every momentum is very strong. The time to worry is when this line declines and it goes below this horizontal line. So right now the VIX is saying the momentum is strong. This line, the stock market, is strong momentum, is above the 200-day moving average, so everything is okay. This line is the percentage of stocks above the 200-day moving average. The main feature of this chart is that when the percentage of stocks above the 200-day moving average is very low, like in here, like in here, like in here, and like in here, you have the bottom of a the beginning of a major bull market. And what this curve is saying is the bottom of the bear market took place last October. This curve is now rising. It shows there is momentum behind the market. And so we are in a bull market. The time to worry is when this declines, and then investors should shift into more defensive stocks. But that's again, is a different presentation. Right now it says the bull market bottom, the bear market bottom took place several months ago. This indicator gives information about the near-term trend of the market and shows the percentage of stocks above the 50-day moving average. This is the percentage of stocks above the 50-day moving average, and this is the stock market, the S&P 500. And as you can see, there is in the short term, when the percentage of stocks above the 50-day moving average goes close to this level, there is a rally going on. This happened here this spring, and of course the market kept on going up. This line is still rising, so I guess the point is momentum is very strong even in the near term. This is a very, very interesting chart, and it could have tremendous bullish implications. And this is it. This is the advanced decline line, and this is the stock market. Now notice that since 2021, the advanced decline line has been absolutely flat and with a rising trend. And what has happened in the meantime, the market went down and then it started rebuilding strength. But what is interesting, that after so many months of trading below this level, finally the advanced decline line broke above this resistance level and has turned up. Usually this is a very bullish signal. Why? Because of the time that it took for the advanced decline line to move above the resistance. So a rising market with a strong strengthening advanced decline line means the market is broadening, and is something that should be considered very, very carefully. What about the foreign market? Can they tell us something about momentum? Well, this is the VEU, is ETF for the global markets ex-US. This has a very interesting pattern. As you can see, in another video, I explain how this ties to the business cycle and how foreign markets are synchronized. But again, you can find this video in my channel. What this is a momentum indicator. It's like the MACD. And what the bottom line is, this is intersecting like here, like in this point, and like in this point. And every time there was a major bottom in the market. So there is rising momentum, is above the 200-day moving average. So even in the global markets, there is some type of, not some type, there is strong bullishness. This is a great chart by Ari Wald of Oppenheimer. He's a great analyst. And what is really saying, okay, this is the S&P 500, and this is the investor intelligence bulls and bears. And what he found out, that when the bullishness rises to this level, the market here, you can see in here, if you read the numbers, in the next 3, 6, and 9 months is going to rise quite strongly. So the odds are that there is basically, what it's saying is that when the bullishness of investors rises to this level, the odds of further gains for the next 6, 9 months is very, very strong. This is an excellent chart. The blue line is the growth in stock prices over 12 months. The red line, this one, is the growth in the monetary base, which is really liquidity, raw liquidity, the first sign that liquidity in the system is going to rise. And what is very interesting that I noticed is that liquidity has been rising since October of last year, which is the time when the stock market has been swinging. So somehow, as the Fed is tightening and all that kind of stuff, somehow there is money going into the system, and probably the only place where it could come from is the government. So if this liquidity keeps on rising, there is only one way for stocks to go, and this is up. The question is, will liquidity continue and there's more money going to be injected in the system? Well, this chart may provide some hints on what is likely to happen. This is the yield curve, that is the difference between the 10 and the 2-year yields. The yield curve is inverting again now, almost 100 basis points, and what it shows is the credit risk is still increasing, but it also shows that is very closely related to the way liquidity flows into the system. So the decline in, or the continued inversion of the yield curve may suggest that liquidity may be turn around and then contract again. It's something to be seen, and time will tell. So what is your conclusion? Are we in a bull market or a bear market? Well, this is how I see it. With all these indicators, they're not all very reliable. I think that's very reliable. There are two types. There is the fundamental indicators that saying the economy is slowing down, profits are likely to slow down, spreads are saying that there is high credit risk, and the yield curve is inverted, and the odds are that this is not a bull market. It's just a rally in a bear market. That's the bearish case. The bullish case is saying, look, the advanced decline is broadening, is going above a long period of hitting a resistance level. All the indicators are saying, look, the momentum is strong. Even the international markets have been turning around. So it's not only the bullish case for the US market, but it also for the foreign markets. So really there is something going on. I showed you the liquidity in the system started rising since last fall. So there is more money flowing into the economy, coming from where we don't know. We just have to assume that it's government spending that is hitting the economy. So there could be a strong case also for the bullish case. Which one you choose? Well, it depends from you. Okay, good luck, and let me know what you think of this presentation. Please do subscribe if you like it, so the next time I have one of my rants, you will get notice of it. Okay, take care. You can enter a free subscription to the Peter Dack Portfolio Strategy Management by going to www.peterdack.com, so you have an idea about my work. I wrote an important book that was commissioned by McGraw-Hill Education on the business cycles, and if you go to amazon.com, you will see that I have really amazing reviews, and I was very pleased. I wrote 2 more books, and on easy money, easy ways to beat the market with ETFs, and then this one, investing wisely, it is easier than you think. All my articles are found on www.peterdack.com. Of course, I would love that you subscribe to my videos, so I will be able to send it to you, my new rants.